Good morning, everybody, and welcome to the Daily Energy Markets podcast, where every morning we take a quick pulse on the direction of travel in the oil markets as they open in Asia. And as we look at the moment, the prices on Brent trading just below $95 a barrel, but they did an intraday trade today, move above 95 and have pulled back a little bit after opening. So we're kind of back where we started, but nonetheless still up a little bit on the day. Big news, of course, I suppose, is always when the Saudi energy minister talks. He gets the world's attention, particularly in a very tight market, and that's certainly the case yesterday. But I'm wondering, as we go forward, is the market considering his comments to be bullish or bearish? Maliha Bengali, founder of MB Commodity Corner. Maliha, your thoughts, and particularly welcome your insights on his comment that the markets need a little bit of a tweak in order to keep the volatility away.
Thank you, Sean. So it's really interesting because obviously the commentary coming out right now is a bit conflicting. You know, on the one hand, they talk about how the markets are seeing weaker demand and they need to cut to justify to provide price stability. But on the other hand, they talk about this clean energy transition. Obviously, everything goes hand in hand. To be honest with you, they may talk about price stability and lack of volatility, but we know they're very quick to cut on the downside and very slow to bring back production on the upside. Prices are north of $20 a barrel since June lows right now. There really is no need to keep the extra million barrels per day out of the market. They claim they need to see the data, but having said that, they never saw the data in June before they decided to cut. So it is a bit contentious, but we know they prefer higher prices, but at some point they will be getting a lot of backlash because, you know, demand in China is uncertain, but the markets are tight. At this rate, if we do get a rebound, there'll be a massive shortfall, could be. So it's a bit preemptive and a bit sort of, conflicting as to why they're keeping barrels of the market. It could also be a summer timing issue where because of power burn, the domestic demand, I think more barrels will slowly return to the market from Russia and OPEC, Saudi towards the end of the year. They have to, but it is a bit conflicting in terms of the messages they're putting out there.
Liz Bosley, CEO at Consilience Energy Advisory Group. Liz joining us for the first time and a long-time watcher of the oil markets. Liz, I'm wondering, we're living through a period clearly, and you would say the Prince Abdulaziz era after we had the sort of Ali Naimi era. The Prince Abdulaziz era is an era in which the OPEC Plus group has very tight reins or likes to have very tight reins, according to the language that His Royal Highness Abdulaziz bin Salman uses, is that they're a kind of a central bank of the oil sector. Your views on that as a strategy and sort of keeping those tight reins, does it successfully keep volatility at bay?
Well, I've been around in this market since 1978, and I've seen all sorts of cycles. I've seen all sorts of attempts to control the price, to control volatility, all of which have come to nothing because experience has taught me that this market is fundamentally unforecastable, and being unforecastable, it is uncontrollable. Ask me what's going to happen over the next couple of months. I don't know. Is this new strain of COVID a threat? What's the weather going to be? What's going to happen in Ukraine? This is very much an event-driven market. So yes, Saudi Arabia and the OPEC Plus group may attempt to control volatility. Jolly good luck to them. It's like Sisyphus pushing a boulder uphill. If they succeed in their direction, they're going to overshoot. It's uncontrollable, and the only way you can take control of it is by saying, this is the price I need. I've got that price available to me in the market off the forward curve. Let's hedge it.
Let's welcome Jose Chalhoub, political risk and oil analyst consultant at Venergy Global, based in Caracas in Venezuela. Jose, clearly OPEC Plus and His Royal Highness, the Energy Minister of Saudi Arabia, can control Saudi production and obviously has influence over the rest of OPEC Plus participating in this supply agreement. But that does not include Venezuela, Iran, and we've seen Iran return a lot of oil production back this year. And there's growing signals that Venezuela might have a pathway to rehabilitation in its relationship with the US and its ability to produce and export oil. How does that pathway look to you?
Yeah, thank you, Sean. Well, yeah, it'll much depend on how politics and the negotiations, and well, these couple last weeks have been plenty of rumors and versions about Washington to lift all sanctions against Venezuela's oil sector, which is, I mean, totally needed for Venezuela to try to recover or get back on the path to recover oil production, because the production of Venezuela has been stagnant in the last couple of months in the range of 700,000 barrels per day, without being able to reach the goal set by the government to reach the 1 million barrels per day. We have seen President Maduro traveling to China these days, trying to seek fresh funds, which according to different versions, Beijing was not, it's not going to be able to give away more funds unless Caracas doesn't pay the current debts that it owes to Beijing. But it all comes down to how negotiations between Washington and Caracas will go on. That's how I see it. And because now we have Chevron here, but Chevron has not been able to, to recover significantly oil production. It's not, it doesn't depend.
What would you, sorry to interrupt you, Jose, but what would you identify is the key block to the pathway, ultimately in our subject for greater oil production and so forth, but inevitably the gateway to that is a diplomatic resolution of some description with the US and Venezuela. Although we've seen Iran get to a sort of a new dawn of forgiveness without any deal. They did a big deal yesterday in terms of the prisoner swap. But what does Venezuela need to do? What is the first gateway that needs to be cleared in order for this pathway to open up for Venezuela?
Yeah, Washington always has demanded free elections, and that's going to be held next year here, presidential elections. But on the other side, the opposition is going to be holding its primaries election in the next month of October. But the opposition doesn't find a way to pick a unified candidate. The credibility in the opposition here is tremendously discredited. Washington seeks free and fair elections, but the only way it can get it is by having Nicolás Maduro again with a new term in power.
Maliha, today, of course, is the next Fed meeting. It begins in Washington. General expectation is that they will hold on their tightening cycle. I'm wondering, from your perspective, the rise in crude up, as you said in your opening comment, up $25 in the last 3 months. But also, most importantly, perhaps for inflation, diesel and middle distillates are up even more than that over that time period. Of course, diesel, the backbone of the economy, whether it be for long-haul trucking or manufacturing, etc. What is your thoughts on where the Fed goes next and other central bank policymakers as we move into another cycle of inflated energy prices?
That's a really good question. So the Fed right now is presumed to be on hold this September meeting. There's a slight chance of a 25 basis points hike, but market participants, investors, traders, fund managers all expect about 4 rate cuts next year, right? So the market's pretty much assuming the Fed is done and dusted and the next move is going to be a cut, which is really preemptive because we saw the August CPI data show a tick up of 0.1% on the inflation. So inflation is not a done deal and they are nowhere close to the 2% target. We are not going to be in a 0-2% range for probably years to come. So the big question here is, does the Fed raise their inflation target from 2 to 3%, or the raised rates. Having said that, the employment market is actually holding up really well right now. The markets are holding up. The Fed has no excuse to cut or to pause. If inflation ticks up, they can raise rates higher. And we know they will at least keep rates higher for longer. And that's something that's the biggest disconnect in the market. People assume there's going to be a cut. What if we have 5% rates for the next 6 months? Can the
Well, it's hard.
economy?
I find it hard to identify why they would stop. I mean, the economy's booming, there's full employment, and inflation is still double the target rate. Why would you stop?
Absolutely. The market is fighting the Fed. The Fed saying that they won't actually have to stop. I'm on your page right now. So the longer they keep the rates higher, something will snap. Their whole purpose is to get inflation down and get the economy to not grow as fast, because inflation is a huge concern. So that's the biggest disconnect in the markets and even equity market valuations. People are the bond market and the equity market on two different tacks right now. So yes, if the market comes out and they speak a bit hawkishly, I think there'll be a rude awakening for the dollar to rally and markets to sell off. And that is the big disconnect in the market. So we'll see what the commentary is about, but they have maintained a hawkish bias, no doubt.
Liz, looking at the sort of new supply opportunity at these levels of pricing and you know, on a historical average, inflation adjusted, $90 isn't what it used to be. The last time we were in the hundreds, let's say 2011 to 2014, you know, it's 10 plus years ago after very serious inflation years. So the price on the Brent is not, you would say, from that point of view, overwhelming. But your thoughts on what it does or what it's needed for development of new oil supply, and in particular reference to areas like the North Sea, where these levels will allow investment to come back?
Mm-hmm. Yes, most certainly. These prices are starting to get very tasty for producers, and a lot of projects that were previously uneconomic are becoming economic again. There's a lot of asset trading going on with small companies buying into the discarded assets of the majors, who the projects don't pass the majors' hurdle tests, but they're still very interesting for smaller companies, the sort of one field companies. So yes, I think it will bring in more. The latest licensing round in the UK has opened up some new acreage, and there is encouragement to continue to invest in oil, despite the environmental protests that want us to stop oil tomorrow and stop using it. I think if I was developing an oil field at the moment, I would be taking some serious financing of the forward oil curve and locking it in. And I think that is the only way you can justifiably bring new production on at the moment, because you just do not know what the environmental agenda is going to do. And as we get into the next conference of parties of the UNFCCC in November, there is always the possibility that there may be a breakthrough. I've been saying that for the last 27 meetings, but maybe this is the one where we may get a breakthrough and do something about it. But if you're developing new fields and using financing off the forward curve, I would just raise a red flag and say, remember, when you're doing this, that the instrument you've been using, which may very well be Brent, please be aware that Brent is no longer Brent. Brent is now WTI. And this is a technical issue, but it's quite an important one, because if you're renewing contracts from last year or doing financing off the curve, don't think about Brent. It's still called Brent, but now it's WTI, and WTI trades at a discount to Brent. And this is a consequence of the change of the makeup of what we call Brent in the market. It's Brent.
I suppose in that regard, Brent hasn't been Brent for a long time, because before WTI, it was 5 different North Sea crudes. So it's sort of, in that way, it's a basket that's always been a balance of crudes to come up with I suppose, a fair market price if it achieves that. Let's go back to Venezuela.
Sorry, can I just comment one further point on that? Yes, it has always been a basket of North Sea crudes. Now it's got WTI. WTI is not a North Sea crude. Something has changed, and be aware of it. That's my message.
Jose, I wanted to get your thoughts on, obviously, the President Maduro was in China in the last few days, and in the week after that, the BRICS, the BRICS group of countries was expanded. What is the outlook for Venezuela joining the BRICS, the expanded BRICS? Is that something that will have any tangible difference, do you think, for Venezuela if they succeed to become a member of this new group?
Yeah, that's an important question. And well, geopolitically speaking, and in terms of oil, and considering how, for example, Saudi Arabia was invited to join the bloc. Well, if Venezuela gets admitted, because it hasn't been invited yet, and Maduro was in China seeking Beijing support to join the bloc, but geopolitically speaking, it will be relevant to Venezuela. But it won't make much of a difference because Venezuela has different alliances with countries like China, Russia, Iran, Saudi Arabia, for example, or other countries. And it has been seeking those type of alliances in the last recent years under Caracas multipolarity ideology, right? But in terms of getting access to foreign capital or capital markets, it won't make much of a difference because the characteristics of different countries, members of the BRICS, with closed capital markets or restricted capital markets. So for Venezuela, geopolitically speaking, it'll be relevant. But for now, I don't think Venezuela will be accepted for now and the alliance in the bloc.
The situation, Maliha, as we kind of gone into, we had a commentary on yesterday, this was to be the year of two halves. China was to be the engine that lifted the energy markets forward. And surprisingly, China hasn't been that, and yet we still have had the liftoff of obviously the energy oil markets have still in the second half of the year advanced, as we talked earlier, by 30% since the low in June, but driven by completely other factors than China's, than the expected China economic recovery, although China imports have remained high. How do you look as we go into the last quarter? Where does China's role, China's impact on the oil markets going forward? Some analysis yesterday saying China is currently not a factor for the oil markets.
So China is extremely smart. If you look at the crude imported data for the last few months, they have been importing a lot of crude, but I think the market is displacing that demand as real demand. They've been taking their crude to refine it and actually sell it back out as products. This is an arbitrage the Chinese is doing, and they probably realize refining margins are artificially very strong because we know that Saudi cutting their production is leading to a distortion in the physical markets in heavy oil, and that's distorting distillate markets. So what they're doing is they're demanding this crude and making more products. So this really is not a tight market. China will never pay such high prices, and you look at the crude storage inventories, they're very high right now. So the big question is China may not come back and pay $95 per barrel. They have enough oil on guard right now to use from their own inventories. If that happens, what will Saudi Arabia do, and what will the oil market do? Because
maybe that's the policy of Saudi Arabia, is to compel China to use some of those inventories that they have built up over the last year, which is quite significant, over 1 billion barrels.
You're right, but if that happens in the next 2 months, they don't buy more barrels, and you have US and Europe with slow demand, what happened to the marginal demand buyer? So crude has been seeing, very good demand the last few months and less supply. And I think that's about to change, or it could. It all depends on the weather and winter and the global economy. But given our forecast and what we are picking up, we are seeing like a recession. So we don't see incremental demand. And everybody in the equity market has been forecasting a first half recession, which never came to realize. And now they're getting very bullish. So I think this could be like a flip of what people expect. We don't know. Time is going to tell. But in terms of a soft landing or no landing, we don't see demand picking up right now in the next few months.
Let's go to the survey question and get the view of the room and then post on social. The commentary yesterday by the Saudi energy minister about light-handed regulation, that sort of central bank function in the oil markets. Does light-handed regulation limit or increase volatility in international energy markets? Because I suppose light-handed regulation from one perspective might be OPEC or Saudi Arabia doing this, for example, unilateral cut. Another might be this US government taking stock out of inventory as they did last year, and they would maybe perceive that as their own version of light-handed regulation because they want to tweak the market in a different direction than others. So I'm wondering, this general term of this light-handed regulation, which ultimately is sort of a government intervention of some description, limit or increase volatility in international energy markets? Welcome your thoughts on that. Let's see where we go. Liz, the idea of developing new resources, and you talk there about your early comment, the convergence of the energy transition with the energy security and the access to capital, and where the energy transition will sort of mothball energy security. Or how do you see those two things coexisting now after a year, coming out of Glasgow, COP26, we had a very strong energy transition drive. Then in the last year of Ukraine, its energy security has been very dominant. Where does that leave the industry in Europe and the UK with access to capital and progressing under those conditions?
Yeah, access to capital for the oil industry has always been a problem, but when all of international effort is focused on trying to reduce the use of oil, you have to think very seriously about why you would invest in oil production. My advice would be, don't worry about it. Oil is here to stay. It's not going to go anytime soon. The reason I say that is, right now, there's about 1 billion people on this planet who don't have access to electricity. By 2050, we're adding another 2 billion people to the pot. Where is the energy going to come from to give those people a reasonable standard of living? We can't get rid of oil because we do not yet have anything to replace it. We can supplement it, we can play around at the edges, but the only thing we could do to get rid of oil is to fully embrace nuclear, and that ain't going to happen. So oil is here to stay. If you're thinking of investing in oil, do it wisely, do it in the right area, and it will pay dividends in the end. But there is going to be huge volatility, so hedge, 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 hedge. That's always my message. If you've got the price you need, grab it and hold on to it, because it's a maelstrom out there and you don't know what tomorrow is going to bring.
Well, let's get some sense of what tomorrow might bring in Latin America. And I wonder, Jose, if you might give us a sort of a more broader sweep on developments there. Clearly, Guyana seems to be the sweet spot, heading towards 1 million barrels a day and beyond. Can we see more supply from other parts? Obviously, we talked about Venezuela, if they can clear their political pathway with the US. Other areas in Latin America can add to that non-OPEC supply?
Sure. Brazil, keep an eye on Brazil. Brazil, ever since Lula got a new term and won his new term as president, things have not been going that bad for Petrobras, for example, and Brazil is projected to rise its oil production in the coming years. So definitely,
are they getting the access to the capital that they need for that?
I mean, things have not been going that bad. I mean, and Petrobras has been performing extremely well in the last couple of months, for example, in terms of, I mean, the hot issue of dividends paying by Petrobras to its shareholders and all that. I mean, which has been a hot issue. It still hasn't been solved by the Lula administration, but Brazil's oil production is projected to rise in the next months, and OPEC has always been pointed to Brazil and Guyana as a hotspot in terms of Latin America oil production, in terms of their growth. Argentina, for example, we have elections in Argentina soon, where this libertarian polemic candidate, Javier Milei, Javier Milei is considered the Trump of Argentina. So there's lots of expectations on his potential winning in the next presidential elections and how this could influence investments in the Vaca Muerta, for example, this huge gas field in Argentina. So definitely I'll keep an eye on Argentina as well. So Argentina and Brazil, aside from Guyana.
Brazil now producing about 3 million, a little over 3 million barrels a day, and have identified the getting over 5 million in the next 5 or 6 years. Is that fanciful, or is there a clear pathway for that to occur with capital and reserves in the ground?
Well, I don't doubt it, because I mean, Petrobras has an extremely important reputation, positive reputation.
Suffered greatly under the last administration in Brazil.
Yeah, especially under this corruption scheme called Lava Jato. But definitely, I mean, Petrobras still keeps its reputation, its position as one of the most important private oil companies. It has important offshore reserves and an experience in terms of offshore production. So I don't doubt it. I don't doubt that Brazil could raise its oil production in the coming years.
Let's give the last word this morning to Malia and get some sense on what are the North Star that you're looking at for direction of travel here. And we're seeing as we said at the beginning, why would the Fed stop raising rates when everything else is looking very positive? I mean, global growth might be a little bit obviously down, but ultimately, where do you? And we now have the OPEC Plus. Who typically in the past were guided by sort of that, where is the 5-year average for inventories, and that's sort of been the neutral spot, but that also seems to be gone. I'm wondering, Malia, where do you think the sort of the key data points, the key direction of travel tells us where you look to get some certainty, because there is so much counterintuitive activities going on?
Yeah, I think we need to keep an eye on the dollar and US bond yields. There's a lot of treasury supply coming to the market at the end of this year, because obviously we know the US funding is still an issue. There might be an issue with the deadline on the 1st of October where there'll be actually another sort of debt shortfall. So I think also of macro issues will play a very big role in the next few months. Bond yields have been ticking higher. We are now seeing real yields close to 2% in the 5-year and 10-year. We've never seen these yields ever in the history. So how is a market that's so debt levered is going to handle such high yields is going to be important. We've seen credit markets, which actually, obviously banks are not lending as much. So the economy is getting tighter and tighter. And I think that's be some sort of an economic snap, which might force the Fed. But my key focus right now is on the macro, like dollar, US bond yield, and credit markets, because I think that's going to dictate where equity risk premium and equity markets and asset classes go.
The survey result was showing that the sort of light-handed regulation intervention from government does increase volatility, sort of 2 to 1 on that. We'll post that on social media and see if that does also play out. One of the areas that I'm looking at for terms of at least sort of direction of travel as to the robustness of OPEC policy and keeping the market tight, or a light-handed regulation, as the Saudi energy minister called it yesterday, is all of their 2030 vision projects, particularly the likes of the signature ones, NEOM and others. If you keep an eye on them and the extent of which those projects, small ones like, I was looking at a report the other day of an incredible 5-star hotel being built into the side of a mountain in Al Ula, this new remote resort in the kingdom. The cost of that would be of any average hotel, but the cost of that it would be massive. Just like I suppose the cost of the football players, Ronaldo and others going into all of these costs that are going into the transformation of Saudi Arabia are significant, and as they all stack up, they require a lot of revenue. view. And so when in doubt of where one might find direction of travel from the standard 5-year averages of global inventories or China's economic growth macro level or whatever, look to the Saudi projects that are being tendered for major construction and infrastructure build, and you'll get some sense about how robust the intention is by OPEC Plus to keep the market tight. That's my few words for today. Thank you so much to our guests who joined us this morning and our new speakers as well. Great to have Liz Bosley joining us, CEO of Consilience Energy Advisory Group, Malia Bengali, founder and CEO of MB Commodity Corner, and Jose Chalou, political risk and oil analyst consultant at Venergy Global. Thank you all very much and have a great day. All the best.
Thank you. Thank you.
Goodbye.